Hello, everyone, and welcome to our education series, Stock Investing 101. Today, we have a crucial topic to discuss: the stock market crash. With recent market volatility, it's important to be prepared and have a solid plan in place. In this video, we'll explore strategies to protect your portfolio and even capitalize on opportunities during these challenging times. Our today's lesson has four objectives. First, we will understand what is stock market crash or recession. Second, what triggers them. Third, how to protect your portfolio stock market crash. Fourth, and most importantly, what you can do during a crash. So without any further ado, let's get started with, what is stock market crash? A stock market crash refers to a sudden and significant decline in the value of stocks across all sectors, resulting in a significant decrease in the overall value of the stock market. This decline can occur for various reasons, including economic factors, market bubbles bursting, natural disasters, and other events that lead investors to lose confidence in the market's future prospects. A stock market crash can cause significant financial losses for investors and can have a ripple effect on the broader economy. Historically, the stock market has always recovered from crashes, but the recovery period can be long, painful, and unpredictable. Some of the well-known stock market crashes in history include the Great Depression of 1929, Black Monday of 1987, the dot-com bubble burst of 2001, the financial crisis of 2008, and the crash that happened during the COVID-19 pandemic in 2020. The primary difference between a stock market crash and a correction is the severity and duration of the decline in the value of stocks. A market correction is a temporary drop in the value of stocks, usually between 10% to 20% from their recent peak, while a crash is a more severe and sudden decline, often exceeding 20% or more. A correction is usually shorter in duration, lasting several weeks to a few months, while a crash can last for a more extended period, sometimes years. Let's take a step further and discuss. What are the triggers of a crash? Stock market crashes typically have a trigger, which can be a specific event or a combination of factors that lead to a significant decline in the value of stocks. The trigger can be anything that causes investors to lose confidence in the market. Black swan events: these are rare, unforeseen events that significantly impact the market. For example, the market fell drastically on the rumors about COVID-19 even before it entered the USA. Economic factors: a weak economy, recession, excessive leverage, inflation, or rising interest rates can cause investor confidence to decline, leading to a sell-off in the stock market. Bubbles get burst: overvalued stocks or excessive speculation in the market can create a bubble that bursts when investors start to sell their shares. Natural disasters: natural disasters such as earthquakes, hurricanes, and pandemics can disrupt supply chains, cause economic uncertainty, and lead to a decline in the stock market. Let's move on to how to survive a stock market crash. Here are some most used strategies used by world-renowned investors to protect your portfolio. Strategy number 1: diversification. One of the most effective ways to protect your portfolio is by diversifying your investments. Spread your holdings across different asset classes, sectors, and geographic regions. This way, if one sector or market experiences a downturn, you'll have other investments that can help cushion the blow. Strategy number 2: risk management. Setting stop-loss orders and regularly reviewing your portfolio's risk exposure is crucial during volatile times. Determine your risk tolerance and adjust your portfolio accordingly. Consider reallocating your investments to safer assets, such as bonds or cash equivalents, to reduce potential losses. Strategy number 3: long-term focus. Remember that the stock market has historically recovered from downturns and delivered positive returns over the long term. Instead of panicking and selling during a crash, consider staying invested and even look for buying opportunities at discounted prices. Remember, successful investing requires a long-term perspective. Strategy number 4: dollar cost averaging. This technique involves investing a fixed amount of money at regular intervals, regardless of market conditions. By consistently investing over time, you can take advantage of market downturns and potentially lower your average cost per share. Dollar cost averaging can help smooth out the impact of market volatility. Strategy number 5. Educate yourself. Knowledge is power when it comes to investing. Take the time to educate yourself about the stock market, economic indicators, and market trends. By understanding the fundamentals and being aware of market conditions, you'll be better equipped to make informed decisions during a crash. What to do during a crash? Experiencing a stock market crash can be a terrifying experience for investors. It's like riding a roller coaster, but instead of your stomach dropping, it's your net worth. But here's the thing, it's not the end of the world. In fact, a stock market crash can create opportunities for savvy investors to buy stocks at a discounted price and make a profit in the long run. Here are some actionable steps you can take during a market crash to make the most of the situation. Stay invested. History shows us that the stock market has always recovered from crashes. By staying invested, you can wait out the downturn and benefit from the eventual recovery. Think of it like holding onto your seat during a roller coaster ride, knowing that the exhilarating experience is worth the temporary fear. Invest more. A market downturn can create buying opportunities for high-quality stocks that have strong fundamentals and a long-term growth outlook. It's like getting a discount on a product you've always wanted to buy. So, take advantage of the situation and invest more during the crash to benefit from the eventual market rebound. Don't time the market. Trying to time the market by waiting to buy at the lowest point in the stock market can be challenging, if not impossible. However, you can use a dollar cost averaging strategy to invest over time. This way, you can avoid the fear of missing out on the best opportunities. Avoid panic selling. Selling stocks during a market downturn can prevent you from benefiting from the market's eventual recovery. It's essential to stay calm and avoid making impulsive decisions. Think of it like trying to jump off a roller coaster in the middle of the ride. It's not a smart move. Focus on quality. Look for stocks with low debt, a competitive advantage, strong financials, and a sustainable business model. These stocks are like the sturdy roller coaster carts that can weather the storm and recover faster than others. Stay away from risky stocks. Companies taking excessive risks or having weak financials are more likely to experience financial difficulties during a stock market crash. It's like avoiding a rusty, old roller coaster that might break down during the ride. By taking these steps, investors can navigate a stock market crash like a roller coaster ride, using the dips to their advantage and enjoying the thrilling experience that comes with it. As Warren Buffett said, only when the tide goes out do you discover who's been swimming naked. Let's summarize takeaways from this lesson. A stock market crash is a sudden and significant decline in the value of stocks across all sectors, often exceeding 20% or more. It can be triggered by various factors, including black swan events, economic factors, market bubbles bursting, and natural disasters. Diversification, risk management, long-term focus, dollar cost averaging, and continuous education are the most important strategies for investors to protect their portfolios from a stock market crash. During a crash, it's important to stay invested, invest more in high-quality stocks, avoid panic selling, focus on quality, and stay away from risky stocks. We would love to hear from you in the comments section about your strategies for navigating a stock market crash. Whether you are a beginner or a constant investor, we have something for everyone. Don't forget to give this video a thumbs up and subscribe to our channel for more insightful content. As always, thank you for watching, and until next time, happy investing.